Good CPI. Why did central banks buy? Hi, everyone, and welcome to another episode of Insights brought to you by Ainslie Bullion and the Gold and Silver Standard. Today, we welcome back Sam, who's been looking at the situation with the CPI or the inflation numbers a little bit more in depth. We talked a little bit about this yesterday with Alex, and it was quite a interesting insight she was giving, looking at the Chinese data and saying how if you look at what's going on further down the supply chain there, it's really all starting to slow. So I'm very interested to get Sam's perspective on this today about where he sees it with the numbers coming out of the US. So how are you going today, Sam?
Very well, Chris. How are you?
Yeah, good. So the CPI numbers earlier in the week, they surprised a little bit to the downside. And as I said, we were talking about this with Alex, who said, oh, well, it actually probably shouldn't be a surprise when she was looking at what was happening in China. But what was your take on the CPI numbers that we got and what they're sort of saying about the market more generally?
Well, it depends how you frame it, really. You could say um, you could say inflation's much worse than it usually is, or you could compare it to its highest rate and say, look, it's reduced a lot, but look, it's just very slightly under um, the expectation on the positive side, which seems to have given a big boost to the risk markets, which is quite surprising given that they've had such a run upward.
Because it was quite a big jump, wasn't it? Really, on the back of that data, the Nasdaq, the S&P, they just took off, didn't they?
Yeah, and the Dow. So they all took aggressive jumps, not too many retracements. So it looks like it was received very positively. And one of the reasons is that just potentially prices in that the Fed is going to pause.
And we should just let everyone know, normally we would be filming this on the day, and we actually had to film this what will be yesterday afternoon, late yesterday afternoon. So we don't actually know the outcome yet, but we will by the time this airs of that decision. So, I mean, I think it was pretty much priced in at 100%, where we're sitting right now, that they will pause here. Is that what you see is the most likely outcome?
Yes, essentially it looks like it is priced in based on what the markets are doing as well in the different surveys.
Yep. And that's really off the back of that. Like it just went to 100% pretty much when the inflation wasn't higher than expected, didn't it? Like it's become effectively a foregone conclusion in the market size.
Yeah, very, very surprising run upward in all three indices.
Yeah. So do you think the question that's sort of in the back of my mind is, now that we're at this sort of pause point, do you think there is a situation where the good news becomes bad news? Because for months now, it's been bad news is good news. It's that the market sort of look through to the other side of this inflation, saying at some point it's going to turn, and then we're getting the indication now that maybe that's happened. So it didn't matter how bad the inflation was, the market sort of just kept going anyway. Look through it, but I'm wondering now whether the slowdown, does the market start to anticipate that this actually means that recession is here? And I mean, let's face it, it's been the most flagged recession in history. Everyone's expecting it. Is that where we're at now?
Yeah, well, the bond market's been calling it, and different news headlines have been calling it, but it just hasn't happened yet. And now we see it's gone up even further. So look, when it will come is hard to say, or if it will come to 100% certainty. But you can see that the good news can quickly become bad news, because essentially we're looking at a pause, and then historically, what comes after a pause? Well, what comes after a pause is 75% of the time there's a recession.
Right.
And people forget that. They start to think that pause is like the Fed or whichever central bank is just switching the risk markets into easy mode, but that's not the case. If you look at the figures are roughly 75% of the time after a pause happens, they've already broken something. And now that this pause is essentially priced in, what are they saying? They're saying essentially we may have broken something, which is what we were talking about in earlier weeks. So, based on the historical figures, we're looking at a 75% chance of recession.
So, but that's a really interesting point. Do you think that this idea of that 75% that they've broken something. Like we've had lots of indications that they probably broke stuff already when we talk about the banking crisis, and I continue to hear about the commercial real estate being an issue down the track. Do you think that maybe them breaking something doesn't mean that it happens right now? It might have already happened, or it might be in the process of happening, but this lag effect means that we don't actually see the outcome of that for months potentially to come.
Yeah, of course. Even if you just look on an individual basis of someone being too far in debt, it takes some time to feel the pain. Firstly, it can feel wonderful. It can feel
Yep.
like free money, but then things quickly changed. And then you have so many leveraged investments in the economy as well. You look at things like Nvidia and all these different companies that are doing tremendously well, but then there are also people going in leveraged on these investments because they think that bull market's back, it's going to keep going for several years. But what's going to happen when the ripple effect comes through, roughly 6 months later, usually,
Yep.
and wipes out some of these investments where people actually have to consolidate. And that's one of the big, that's one of the things that fuels a big turnaround, liquidations.
Right. And I suppose we haven't seen that. It's starting to come into my peripheral view that just from headlines that are quite stark in Australia specifically saying, this recession that's coming is really going to knock our socks off because we just are not prepared. We haven't been through something like this in the living memory of so many participants in the market. Do you think that plays into it a little bit there as well, that we may be complacent because we haven't been through it? We don't really know what that means unless you've lived through multiple market cycles, and probably further on in your career, the younger people just don't understand.
Yeah, one thing that is something we talked about earlier was the COVID crash or the 2020 crash.
Yep.
That was kind of unique because there was obviously something else going on, and the reaction was extremely swift and pumped markets to record highs. Can that happen again? Now, one of the things limiting that is um, if a big recession, if a big crash comes, um, uh, people are going to be angry. So that's going to influence policy potentially. And if the solution is, again, just print our way out of it, that's going to further affect inflation. And if the central banks have inflation under control so well, or if they're still fighting to try to hit their targets, that's all going to be immediately blown out of the water once they give in and have to further inflate.
That's such a good. There's two really good points there. COVID wasn't like, so when everyone says, "Well, I lived through the COVID crash," that was unlike anything we'd ever seen. That's an excellent point, because if people are expecting that's what a recession looks like, well, that's not your garden variety recession for sure. And this idea that they maybe can't, that the solution there is not the solution they can use now because they're backed into a corner. The debt is so large, you can't just play that same playbook again. I mean, that's actually a bit scary when you think of it in those terms.
And the liquidity pool's bigger now, so to get the same percentage gain, they have to increase that much more.
So
So
yeah, yeah. So it really is sort of end game there that you just can't keep playing that same playbook. So what do you think happens then? So I find it really interesting, and I know you think a lot about this. If the Fed actually is pausing rates here beyond just pausing today, but ongoing, this is it. This is the top. You've identified that lag. They've broken things. We've mentioned all that. What does the Fed actually do? Is there a difference between, and maybe not even the Fed, central banks? Let's talk central banks. Is there a difference between what they say and what they're doing? Because I know you were highlighting that central banks have been moving into gold, right? So where does that fit in this nexus?
yeah, so people may forget it didn't. It was in the headlines just earlier this year, but central banks have bought at a record pace in the first 2 months of 2023. So, according to a report by the World Gold Council, they bought a net 125 tons of gold from January to February. Now, a few very small countries sold off some gold, but overall, for the last 12 months, they're net buyers. Now, if central banks are talking about fighting inflation and having it under control, but in the same half of the year, they're the biggest buyers of gold in the world, how does that how does that inspire confidence in
Yep.
people who are looking to FOMC meetings and ECB meetings and saying, is inflation under control, knowing that they've been buying up as much gold as they can get their hands on, which is a hedge against essentially what they're attempting to do.
So it could be the stereotypical example of do what I do, not what, or they're telling you, do what I say, listen to what I'm saying, ignore what I'm doing. But the reality is we should probably be doing what they're doing and not doing what they're saying.
Yes, so buying gold as aggressively as possible while saying, look, we're fighting inflation. It'll be fine. It'll be under control.
Yep.
And I guess with gold, it's quite interesting because with the risk markets, if there is a crash, if something happens, the recovery becomes kind of a game of musical chairs again. Who's the most likely to survive? Who's going to get back to the top? If you remember with the last crash, people were looking to different companies, whether it was Tesla, whether it was Apple, what's going to essentially save their portfolio. Whereas with gold, it's a safe haven as well as a hedge against inflation. So it's done very well through that period. And it looks like central banks themselves, who are the ones trying to fight this inflation, have identified that as their favorite hedge against the inflation that they caused.
It's absolutely fascinating when you put it in those terms, isn't it? Like to think that you can have the mouth and the body of that beast that is the central banks and monetary policy operating completely, saying different things to what they're doing. It's fascinating.
Yeah, well, headlines have covered it, but a lot of investors just have short-term memory, and they also have really short-term targets as well. Because if you were looking at the CPI data that came out and you're looking for a very short-term trade, well, you've done well because the stock market has taken a jump upwards. But when you keep playing the game of, you know, kind of dancing on the edge of a potential recession, which we've talked about that 70% likelihood according to this data, it
Yep.
becomes very dangerous to jump in and out of risk markets and risk um, the chance that you jump in when it happens to contract.
Absolutely. And I think it probably is a nice place to sort of end on that idea about timing, because that's always the argument with the metals. Or if you're using metals as insurance, right? Like you don't want to buy the insurance after the house is burnt down necessarily. And if there's a lot of indications here that, well, I mean, you'd love to buy the insurance after the house is burnt down, but you're going to pay a very high price. That's how
Yes.
insurance works. So we have all these signs. So it probably does give you a pause at least to think about whether now is a good time to reassess that you are actually covered when we're highlighting such obvious, well, what seem to us as obvious scenarios that can break down here.
Yeah, so that's just one of a couple scenarios, really. I mean, you have keep the hikes going and really crush the risk markets, potentially gold as well temporarily. You have print your
Mm.
way out of it, which ends up being good for gold as well. And then you have attempt some sort of reset, like have a war or some big opportunity to try to prevent a shift in what's happening in global monetary policy. You can see the BRICS nations have been accumulating a lot of gold as well. So that's another option that's on the cards. Hopefully one that doesn't happen, but in all three of those scenarios, gold potentially works out very well.
Lots for us to think about there, Sam, as always. So thank you for your deep dive on this. We really appreciate that.
Thanks, Chris.
Thanks everyone for watching. Remember, reach out if you have any questions or comments on social platforms, and we'll get back to you as soon as we can on those. That's us for this week. We'll be back on Tuesday, I think, next week, probably with Alex to discuss markets and metals and everything we love to discuss. So until then, have a great weekend, everyone, and we'll talk to you later.